Dan Greenhaus of Solus, Stephanie Guild of Robinhood, Brian Levitt of Invesco. It's great to have everybody with us today. Dan, from your notes, you suggest that a lot of the worst case scenarios are already priced into this market.
Yeah, on the halftime show, you talked about how everyone is cautious and worried.
Yeah, you're not?
No, I'm not. I'm sure I'm cautious. I'm not worried. And I think what Megan brought up today, he mentioned some of the auto imports might be exempted from tariffs. That's like 5% of all the stuff that we import are auto parts. And I think Brian and I were talking in the green room before this, and I was saying you've now had exemptions on a number of items. You've had the 90-day delay, et cetera, et cetera. Clearly, this is a president who seems willing to hear from people around him and not push unimpeded into quote-unquote worst-case scenarios. And I think it speaks to some of the rebound that you've seen in the stock market.
I mean, Morgan Stanley today says, quote, investors should prepare to be fooled many more times. They allude to the consistent inconsistencies.
Yeah, listen, they have been consistently inconsistent. I would concede that point. I think where I have differed on the show and in private with some of our investors is just everybody everywhere is assuming not the worst, but something closer to the worst than the best. And I think my thought was there would be a delay. My thought was there would be exemptions. And this, I think, is true for a lot of people, at least at Solus. I just think everyone is inundated right now, both in newspapers, on television, with just these terrible scenarios where prices are going to skyrocket, cats and dogs living together. And those scenarios are more likely than not going to come to pass.
All right, Stephanie, Morgan Stanley today maybe agrees a little bit with Dan, in fact, that the worst may be over. But even if it is, they suggest we're not out of the woods just yet. How do you see the current environment?
Yeah, I think it's kind of awkward because I think we broke up with a bunch of countries, but we're still living together. And we need to kind of figure out how we're going to, are we kind of starting to talk again? Should we actually get back together? On what terms? And I think that's why the caution still exists. We're definitely managing portfolios such in a way that we've taken some dry powder and put it to work last week, but we also started, we haven't fully removed it because we think diversification is important, not only away from the dollar, but also just being cautious and balancing between low volatility stocks and growth stocks and really just kind of watching closely. But there is a put now. I think that's been confirmed, and that's actually really helpful.
But that, you suggest, is not the Fed and it's not the president, it's the bond market.
The bond market put, for sure. Because that's why I think there's still some exemptions coming out because the 10-year hasn't come down, right? Like the dollar being weak and the 10-year staying where it is not a great sign.
You agree?
I mean, that's the old James Carville line of wanting to come back as the bond market so he can intimidate everybody. So we saw that. I think the challenge is I want to be where Dan is. I do. The challenge is the uncertainty persists here. And I agree that, given those initial formulas we saw on the tariffs, that was going to be the worst of it in terms of the tariff rates. But the challenge we have now is how long does this bout of uncertainty go? We're very much more than ever on the whims of the White House right now than we are in a traditional environment.
But I think the issue you have, the royal you have as an investor, is there isn't always clear lanes. It's not always Apple's EPS is going to go up 8% a year in perpetuity. Sure. It's all good. There are periods of uncertainty in which risk premiums on assets go up, and those are the times when you want to take advantage of them. Now, admittedly, to your point, and the point both of you raised, there's a lot of uncertainty out there that we don't know.
Yeah.
Tomorrow we could wake up and it could be 400 tariffs on everybody just because. And I get that. But these are the moments where long-term opportunities present themselves, and it is when uncertainty is typically at their highest or at least higher.
Well, now, so if you consider the 2018 scenario, 2018, you fall 20%. In a quarter, you get a 90-day trade pause, so that starts to sound familiar. You also get a Fed that steps in, and that starts to help. So you shift to a better picture. The challenge I'm talking about, though, is that when you look at business investment or business confidence or Michigan consumer confidence, this could go on a while. I think the risk to all of this is that S&P 500 multiples are not at average. They're not at recession levels. So there's a risk to this. Yes, I want to be in the camp that we've seen the worst, but we've got to set a rate and move forward on it.
I think earnings growth is too high still. It's like at 11%.
And expectations.
Right, expectations, I should say, not what it's definitely going to be. And every time the GDP falls by 1%, it's about a 4% drop in earnings growth over time, if you look back over the last 30 years. So I think the 11% expectation is still a bit too high, and that's where I think, that's why I'm still cautious.